In this video, I'll be going through Chapter 11 in the text, as well as going through some of your assigned problems in Connect. So let's begin. Let's take a look at retirement and other tax-deferred annuities in Chapter 11. So let's start with just looking at some of the terminology we'll be using in this chapter. An annuity is a series of payments, usually equally spaced and of the same amount. Beneficiary is someone you leave your benefits to, so they receive the benefits, for example, upon death. Contributions are made at the front end of a retirement plan, so you contribute to a 401k or an IRA and grow the fund by making contributions and the earnings throughout the life of the fund. And distributions are taken at the other end when you withdraw money from the fund, from the IRA account, for example. And some distributions, such as for a traditional IRA, are mandatory and prescribed by law. A donor is someone who contributes, of course, to a fund. A tax-deferred retirement or other plan, I mentioned a few already. 401k is another one, IRAs. Tax-deferred means that fund will be taxed eventually. It's just you'll be able to defer or delay being taxed on the earnings of a fund, and that's a real advantage. Trustee is someone who manages, for example, a trust account. So a trust is established, and a trustee is someone generally who will manage the trust on behalf of the trust. And usually it's on behalf of the trustor as well, although not always. And the trustor is someone who is the person who creates the fund. So here's some of the terms we'll be using in this chapter. I mentioned earlier, tax deferred does not mean tax free. It's just a means of delay in paying the taxes. And in inflation, that can be an advantage financially, because if you delay paying taxes, then when you eventually do pay the taxes, you'll be paying in less valuable dollars. There are some tax advantages through the various types of retirement plans we'll be talking about, and there are occasionally tax-free earnings. And so when we come across some tax-free earnings, it means that the earnings in a fund will never be taxed, but in most cases they're just deferred. So here are some of those employer-sponsored plans. 401k is pretty popular. These are defined contribution plans. In the government realm, 403b, KEO plans for self-employed folks, and we'll talk a little bit. Simple plans for really small employers. And then the simplified employee pensions, also for smaller employers. Less sophisticated, less administrative costs with these simpler plans. Matter of fact, the 401ks for many companies, medium and larger companies, can be quite expensive to administer for the company. So these plans provide benefits to both the employer and the employee. For the employer, they get a deduction for their contributions that they make to your fund. And these contributions are not compensation to the employee. So the employee is not taxed on it, as long as it's to a qualified retirement plan. And as we talked about earlier, the earnings from the plan investments are not taxed when they're earned. In terms of plan assets or earnings, they're not taxable to the employee until withdrawn, or in many cases it's until the required distributions are made. That is to say, we've taken money out of the fund. Defined contribution plans, they kind of establish the amount of the contribution. The amount of the eventual distribution is not known, and therefore it's risky. So your 401k, if you have a 401k or an IRA, you really don't know how much those funds are going to earn, especially as we've seen in the most recent volatile stock market price changes, that it's very difficult, especially in the short term, to predict where the market will be and where your fund will be. So the risk here for defined contribution plans is borne by the employee. The employer really has very little risk, because they generally make discretionary contributions to your plans. They can withdraw, in most cases, those contributions. In other words, they can withdraw making those contributions, I should say. So they can withdraw making the contributions if times get tough, and the earnings, the performance of those funds, and the risk associated with that performance is borne by the employee. And defined contribution plans are different. Here we pre-establish the amount of the benefit. So if you retire and you're fortunate enough to have a defined benefit plan, here the employer bears all the risk, or most of the risk. They are guaranteeing you essentially a certain contribution after you retire, and they make the investment. So if the market drops and the fund underperforms, then they need to make up the difference because they're guaranteeing you a certain amount of monthly benefit, for example. So if the fund does poorly, they have to come up with the rest, the employer does. So they bear the risk. Most employers have long ago shed and gotten rid of their defined benefit plans because of the cost and risk, and they instead have established the defined contribution plans, the 401ks, for example, 403bs, 457 plans. They've established these plans because now the risk shifts to the employee. A qualified pension profit sharing plans, certain rules apply in order to be a qualified plan. It cannot discriminate. There has to be minimum vesting rules. Vesting means you receive right or ownership rights to the amount of the contribution your employer makes. You always have rights, of course. You immediately vest any contributions that you make to the fund. They're always yours. But any contributions that your employer makes may become yours over time. They may vest over time. There are some additional rules. Additions to these defined contribution plans can't exceed $56,000 or 100% of your compensation. Additions to the defined benefit plans can't result in benefits more than the lower of $225,000 or 100% of your average compensation for the highest 3 years. Now, these are defined benefit plans, so your employer would oversee this. The second bullet point, this is a limitation that applies to defined contribution plans, and this is something that the employee would have to make sure that they don't exceed. (401k) plans specifically, and the 401k, by the way, refers to the Internal Revenue Code section number. The employee can elect to defer up to $19,000, and you can add another $6,000 if age 50 or over. And this has gone up recently as well. KEO plans, these are for self-employed, as I mentioned earlier. Contribution limits generally the same as qualified plans, $56,000 or 100% of the compensation. And we'll do an example of this in one of your problems for your assignment this week. Then there are the simplified employee pensions, where the employer creates and contributes to employee IRAs. Some lower limits here. Maximum contribution is the lesser of 25% of the compensation, or $56,000. And I'll run through an example of that calculation as well. And then the simple plans. Again, the employer creates IRAs or 401ks for the employees. These are for smaller employers, far less expensive to administer. The employee contributes a certain percentage up to $13,000, and then additional $33,000 is allowed if age 50 or over. And again, these amounts have gone up as well. Employer makes matching contribution of 3% for all employees and 2% for all eligible employees. And so you can see the limits on the matching are quite small, but again, this is for, these simple plans are for smaller employers usually. On the individual retirement side, those were employer sponsored earlier. Now on the individual side, you can set up your own IRA, your own individual retirement account. And there are traditional IRAs and Roth IRAs, and they both have advantages and disadvantages. However, the contribution limits are the same. So contributions limited to the smaller of $6,000 if you're under 50, but if you're 50 or over, you can add another $1,000 to that annually, and up to $7,000 now. And this continues to index up over the years. Now, individuals who are covered under employer plan, that has implications for those who have their traditional IRAs. So, for example, under these individual-sponsored retirement plans, deductible contribution amount begins to phase out when adjusted gross income reaches 133 for married and 64 for others, and is fully phased out at 123,000 and 74,000 respectively. So, if you have a retirement plan and it's sponsored by your employer, and then you set up your own IRA, your traditional individual retirement account, then if you make enough money and you have this pension at work, then you may be phased out of the deductibility of your contribution. So you may not be able to deduct your contribution. You can still make non-deductible contributions, but this phase out relates to the deductibility of your contribution for a traditional IRA. In fact, many folks who earn higher income earners often will create a Roth IRA, since those contributions are never deductible. And so they may benefit by purchasing a Roth IRA, because when they retire, their benefits for the Roth IRA are not taxable. So if they're being phased out anyway of the deductibility of the contribution for a traditional IRA, then some folks opt in for the Roth IRA, since they can't deduct anyway with a Roth, and they can't deduct with the traditional IRA because of their income and the fact that they have a pension at work. And so they take a Roth, and then the advantage of the Roth, of course, is that when you take your distributions from the Roth, they're not taxable. All right? So if we make some simple comparisons of traditional IRAs and Roth, contributions are deductible for traditional IRAs as long as they don't phase out for the reasons we talked about. But contributions are not deductible under any circumstances for a Roth IRA. Distributions on the back end of the fund, where you start taking money out, they are taxable for traditional IRAs, but not for Roths. So the advantage of the Roth, of course, is that while you cannot deduct the contribution on the front end when you're contributing to the fund, you can avoid taxation of the distributions, for example, when you retire. So they're trading off the non-deductibility of contributions against the non-taxability of the distributions. Another tax-deferred non-retirement account in this case is a Coverdell Education Savings Account. This is a federally sponsored program that allows you to put money away, and this is tax-free. So the distributions are not taxable as long as the funds are used to support and pay for higher education expenses of a beneficiary. So here we're using the word tax-free and not tax-deferred. These retirement plans, the earnings on these plans, are not taxable as long as you use the funds for the educational purposes of a beneficiary. And any person can establish this federal Coverdell Education Savings Account for any person, himself or herself included. Additionally, there's a $2,000 limit per beneficiary from all sources combined. And then the contributions phase out to these CISA or the Coverdell accounts when the contributor adjusted gross income reaches $190,000 for married, filing joint, and $95,000 for others. And it's totally phased out at $30,000 or $15,000 above those numbers, respectively. So, for example, if you are married, filing joint, and your income reaches $220,000, and that is your adjusted gross income, then you would be completely phased out of contributing to a CISA account. On the individual side, if you, as a single person, for example, if your adjusted gross income exceeds $110,000, then you would be phased out of contributing to the CSEP plan. There are some state-based plans, and these are called 529 plans that are non-retirement and for tuition purposes as well. Earnings grow tax-free again and can be used for qualified expenses. But isn't it interesting? Look at the expenses that qualify, including room and board. So we'd expect to see tuition and perhaps mandatory fees. Books sometimes in some types of plans are permitted, but in the 529s, even room and board is included. But the student has to attend at least half time for the expenses to be qualified and therefore avoid taxation. Generally, the distributions are taxable if the contributions were deductible. And this is an overarching principle in taxation. You don't get two bites at the same apple, right? So you don't get two bites at the apple. You have to, if you get a benefit on the one end of the transaction, you can't get a tax benefit at the other end. So for example, if in a Roth IRA, you're sacrificing the deductibility of the contribution on the front end, so the distribution on the back end is tax-free. And so you eventually get the tax benefit. But you wouldn't get the tax benefit on both ends. You cannot deduct the contribution and enjoy tax-free benefits on the distributions. It's either one or the other. In terms of the contributions, some but not all of contributions made previously with tax dollars, so if they were taxed generally on the contribution end, then they won't be taxed on the distribution end. And so if you have, let's say that you made a contribution that was previously taxed, the distributions will only be partially taxed, and they'll only be partially taxed in some cases on the earnings. Depends upon the nature of the plan. And we use a simplified method here to determine, well, how much of each payment is actually taxable and how much isn't. And you might want to consider that when you make contributions to a plan, you establish a plan, you buy an annuity contract, for example, the money that you put into the fund, whatever kind of fund it is, generally the money you put in is not taxable unless you enjoyed a tax benefit when you made the contribution. Like with a traditional IRA. If you contribute to a traditional IRA and you qualify for a deduction, then the distribution will be taxable. But if you put money into an investment account, that money generally is not taxable to you. That's what you contributed. You wouldn't be taxed on that. The earnings portion of your distributions, however, may be taxable depending upon the nature of the contract or the fund. So this simplified method helps us to bifurcate the amount of the payment that is taxable against the amount that is not. So under the simplified method, for cases where the distributions are partially taxable, we'll determine the number of anticipated payments using single life or dual life tables in the text. And we're going to focus, and I'll show these later, on tables 1 and tables 3, and table 5. So we'll be using some of these life expectancy tables 3 and 5, especially in the appendix to the chapter, and I'll demonstrate those. All right, so we'll look at the anticipated payments based on the expected life, called maybe these mortality tables, or we'll call them life tables. Then we'll determine the total contributions from previously taxed dollars. And again, if it's previously taxed dollars and you made contributions to the plan, then that portion of the distribution of the payment you receive is not taxable. So we determine this fraction based on previously taxed dollars versus the total number of payments. That portion of the payment then will not be taxable. This will be tax-free. Because again, you had no tax benefit when you made the contribution. It was your money. You contributed to the fund. You will not be taxed on it. You were already taxed on it when you earned it. So you will not be taxed on it. But the portion of the payment, the monthly payment you get from a fund or an annuity contract that is earnings, that may have enjoyed tax deferral while it was in the account, in the fund, that portion is likely to be taxable of each payment. So that portion of the payment is likely to be taxable. The best way to make this clear, I think, is to run through a problem, and I'll be doing that in a little bit. We'll demonstrate this simplified method for you, where we separate out the portion of the distribution that is taxable against a portion of the distribution that is not. So, for example, if you buy an insurance contract, you put in $20,000 into the contract, and that $20,000 was previously taxed, for example, as earnings, then when you start getting your payments from the fund, that portion of each payment, the amount you contributed, is not taxable. I mentioned earlier that there are required minimum distributions from certain kinds of funds. Since this is the tax year 2019, the required minimum distributions is still at the year following you reach the age of 70 and a half. That's gone up for purposes of filing your taxes after December 31st, 2019 to 72. But our tax year in this course is still 2019, and therefore the 70 and a half age limit where we are required to make distributions still applies, but it did go up to 72 for years beyond December 31st, 2019. And these required minimum distributions are based on the life expectancy. And normally we'd use Table 3 in the text to determine how long the fund holder will live. And sometimes we can also include in that the beneficiary's life as well. And we'll run through some examples of these distributions using these tables shortly. I mentioned earlier the Roth IRA distributions, money taken out of the fund, are generally not taxable. The earnings are taxable if they are withdrawn prior to a 5-year holding period. So if you had the fund for less than 5 years, then the earnings, if you withdraw, would be taxable. But if you hold it for the 5-year holding period, then neither the earnings nor the contributions are taxable when you make or receive the distributions. I said earlier the Coverdell education savings accounts are tax-free if they are used for qualified expenses. You cannot take, again, more than one tax benefit for the same tax dollar. So if you enjoy the benefit of the CISA tax-free on the distributions, then you cannot also take the American Opportunity or Hope or Lifetime Learning Credits. So you cannot get an additional tax benefit for the same tuition dollar. And that's true generally for all tax dollars, that you're not going to be able to get both a deduction and a credit, for example. Or the distribution can't be both tax-free and you get a credit for it. So you should only get one tax benefit per tax dollar if you qualify. If you take money out early from an IRA, for example, or a qualified plan, then you may be subject to a 10% federal penalty. If you leave an employer, for example, or you want to roll over an account, a qualified retirement account, generally, as long as the dollars are distributed to the employee and reinvested in a qualified plan within 60 days, then you avoid taxation on the rollover. But if you hold the money more than 60 days in a non-qualified retirement account, then the entire amount is taxable. That's a very serious consequence. So some folks, if they leave jobs, they might ask the employer to roll over or send the retirement funds in their retirement account over to the retirement account of the new employer and make an electronic transfer that way. I mentioned annuities before. It's a series of payments that are related to a contract, usually often an insurance contract. These annuity payments are partially taxable and partially tax-free, and we talked about that earlier. Which portion is tax-free? We can use a simplified method to determine what part of each payment is tax-free and which part is taxable. And use the amount that we contributed is tax-free, and the amount of the payment that is based on earnings while it was in the annuity would be taxable. Let's take a look then at some examples in the text of these annuity tables here. Let's go to, first of all, look at the annuity tables themselves. These are in the appendix to your chapter. And I mentioned earlier, we'll be using mostly Table 3 and Table 5. And Table 3 is a uniform lifetime table. And these are sometimes referred to as mortality tables. These are an estimation based on a person's age of how many years they have ahead of them. In other words, how many years they'll have received benefits from the fund. And then Table 5, this relates to ordinary life annuities, and again, it's based on age. But these are for annuities specifically. Table 3 is kind of a uniform table for life expectancy in general, based on a person's age. So we'll be referring to these tables when we look at some problems. Oh, I did want to make a note here. On one of the problems you have in Connect, you're looking at KEO plans. These are those self-employed plans where individuals can contribute up to $56,000 or 25% of the earned income from self-employment. So this is that limit, and here you'll have to set up an algebraic expression. So let's go through an example of this. Walter is self-employed. In 2019, his earnings before the KEO deduction, but after the deduction for the 1/2 of his self-employment tax, are $60,000. His KEO deduction for purposes of the 25% calculation, you take the $60,000 of income, and then you would subtract from that 25% of X, and X is what we're trying to determine, and that is the deduction. So to solve this algebraically, we'll just take X equal now to 48,000, because we would take the negative 0.25X and put it on the right as a positive number, and so we would have 60,000 equals 1.25X, and then 60,000 divided by 1.25 is 48,000. So what this means then is that Walter is entitled to deduct the lesser of 56,000 or 25% of the 48,000, which is 12,000. So he could take the $12,000 deduction, and this is the lesser of the two, but you first have to set up this algebraic expression. So in the next video, I'll run through some additional problems that will help you with your Connect assignment.